Hello, and welcome to Mac and G. My name is Ben Jones, and we have a special guest today here who graduated from econ from Purdue University. He was previously a banker, and he has some very insightful things about what we call angel investing. As we start today, we're going to welcome here Ben Pidgeon.
Thank you.
Hey,
Excited
Ben.
to be here.
Welcome to the show.
Hey, Ben, welcome to the show. We're going to give a little bit of break so they could do the music, but
Gotcha.
You just jumped right in. I love it, man.
No.
How you doing today? You doing okay?
I'm doing great.
All right. Well, we're really happy to have you here. I've learned a couple of really cool things about you. I think like all young men, we always want to impress the women, and we want to meet as many women as possible. So we're going to have to get into that and how you did that in college, because I think that's a great story. But what do you have going for yourself just today? Anything new and interesting this week?
No, this week's exciting because we're distributing like 900 K1s.
Whoa!
What's a K1?
That's like a Christie is number one. Like my wife's name is Christie.
Yeah.
She's number one.
Yeah, sure.
A K1, it's a tax. A tax term about ownership, on a percentage ownership, and you have 900 of them because you have some very interesting backgrounds on what you do, and that's why you're here.
Yeah.
So, do we start with the fishbowl, Tony?
Oh, the magic fishbowl. I want to apologize in advance for Ben's idea.
This is Tony's idea. We're going to give you this. You're going to choose one piece of paper out of there,
and you guys are going to answer it?
Whoa, we got to remember. No, you get to answer.
Oh, I get to answer.
Yeah. So
don't
pick
look,
one out there. Don't look. Just reach in, pull one out, read it, and
no
then
cheating.
Tell us here. Oh, and we got Tony Petro here too. I think people should know you right about now, right?
I feel like I'm a guest a lot here.
You are not. Yeah, I guess you're a guest. Yeah,
And by the way, he said, how men are always guys are always trying to get with lots of girls and whatnot. Only one girl for me.
And you know where that's going, right? That's my sister.
He thinks it's funny when I tell him about his sister.
Oh, yes. I think it's an uncomfortable laugh. So what do you got there? What's going on, Ben?
My question is, what makes you feel old?
What does make you feel old, Ben? You're a decade younger than me, and you're 2 or 3 decades younger than Tony. What's going on?
What makes me feel old? When my kids look up to me and say, "What's a telephone, Dad?"
Whoa.
Right?
I think that's a good one, right? Do they actually say rotary phone or just telephone?
Recently, they were at their grandma's house, and they came across one of those and got a kick out of doing a rodeo phone.
Rodeo phone?
Rodeo phone.
Hee-haw!
Right?
Tony's about ready to say something.
Is this an adult show?
It is, but you got to be careful. We're trying
Can
to
you
make
beat me out? I'm about ready to say something really scary.
Well, let me write it down. So you have a telephone is what makes you feel old, and congratulations on that. But tell us just a little bit about yourself, because your current job is quite honestly fascinating. Talks about money. You're into investing, and you were a banker before. We'd just like to hear a little bit more about your story.
How I got to VisionTech?
Yeah, that'd be great. Like, what was your prior job, and why you went to VisionTech, and what gets you excited about VisionTech?
It's funny. Last week I was doing a similar podcast, and it
cool.
Similar, but not as good.
Not as good. Tony, I got lucky. I feel like it. And I often ask the question, would you rather be smart or lucky? I think I'd rather have more luck than smart. That's just how I take it. But I went to Purdue for a degree in economics.
So you didn't start off lucky. Go ahead.
No, I did not.
Oh, my gosh.
Starts out of the gate.
That reminds me, Ben Jones went to Purdue for his first year.
Yeah. Oh.
And then he transferred to IU to finish his degree. And when he transferred, the average IQ went up at both schools.
He uses that every podcast he's on.
I'm trying to work. It's like Arnold Schwarzenegger's "I'll be back."
He wants to work that into every movie, right? Okay.
That's funny. I've heard the same thing about New Zealanders and Australians.
Whoa!
And what's that?
That I was at an angel conference and the same thing happened. Actually, these guys were betting back and forth, and you know what happened when?
Yeah, but
somebody moves from Australia to New Zealand.
Yes.
New Zealand to Australia.
He is the mighty fighting bird of what do you call Ball State. So I mean, I just don't feel like it's fair.
Fiercest
I just don't feel like
Robin-sized
it's fair.
bird on the planet. Chirp chirp.
Chirp, chirp. We're going to get you. Chirp, chirp.
Yeah, yeah.
But anyway, go back to your story, Ben.
So went into banking. Had a lot of fun doing mortgages and kind of working my way up the corporate ladder. And then
now, was this in the 2006-07 leading up to destroying the economy?
Yeah. I was.
You had a lot of fun.
I had friends doing that, and it was funny actually. There was a moment in the mortgage industry where I was like, this is just not sustainable. And I remember a conversation where we were looking up to a top performer, and he had just closed a monster month, got a huge check, gigantic check,
6 figures in 1 month. Okay,
yeah. And then on Monday, I remember saying, I wonder what this guy did this weekend. What did he do?
And what did he do?
I said, hey, Mike, what'd you do? I got each one of my 4 kids a 4-wheeler. And we just tore up the yard the whole weekend long. And I'm thinking to myself, this is just not sustainable. Like, how is it possible that you could blow it all? And I didn't ask him how much they were, any of those details, but I thought to myself, this is just not sustainable in the industry.
And then how much longer until it kind of fell apart?
It took another 5 years after that.
Wow. So that was
really early.
For quite a while.
Right.
Okay.
Yeah.
Yeah. I remember telling my wife in Chicago that we were driving downtown, and I go, I don't understand how all these buildings could go up when people coming into Chicago was moderate, not even excessive. And you have 3 or 4 times the number of units going up. And I said, something's wrong. And she always reminds me of that. She goes, you remember when you said that? That was like the start of the end. And I thought, hey, I feel so smart.
Just out of balance, right?
It was out of balance.
You jinxed it. You jinxed everything.
I did jinx it. Sounds like Ben jinxed it 5 years early. And so you just did these mortgages. You're working at the bank, kind of enjoying it, but
and then I went back to school, got my MBA from Kelley School of Business
at IU. Okay.
At IU, with the intention of getting out of banking.
Not everybody knows where that is. Wow, it's the number 1 MBA school for public universities, but it's okay. It's okay.
Yeah. And met a professor by the name of Todd Saxton. I'm channeling Todd Saxton through this beard today.
Okay.
He's good, great strategy professor, good guy.
Okay.
And through Todd, I got involved with the Venture Club of Indiana, and met Oscar Morales.
What's the Venture Club?
I was going to say, what for people that are just learning about money, what is a venture club?
Yeah, Venture Club of Indiana is a 30-year-old organization that's been around for
30 years.
You could tell he went to IU.
Yeah. Oh no, this is going to be the whole way. Chirp chirp. Go
ahead.
Cheers. It was back in the 80s, it was kind of the place that you went for deal syndication in Indianapolis. It was a deal sharing platform where people got together and heard pitches. And
so when you start talking about deal syndication and hearing pitches, you're talking about people that have an idea of a company and normally have already started something, right? And they're saying, hey, I'd like to get some money put together, and will anybody invest in me? Right.
Yep.
And so they come to the venture club and they tell you or give you the pitch on what their company is all about, where they're headed, which industry they're going to be in, how much money they're going to make, and all these crazy stuff, right?
Yeah. How big the market is, what the management team looks like, what the opportunity looks like. Why would somebody buy their company after commercialization?
Exactly. So if you got into something like Amazon, like when it was starting in the venture club, because that's what happened with Amazon. They got a lot of venture rounds. Then if you got in early, if you hit the right one, like a unicorn, you could make an absolute ton of money, right?
Yes.
So people are coming to you, giving you pitches. You're sitting around talking about it. And then what's going on with you?
So then you raise money and you might take on a board seat. Somebody writes a big enough check.
So you're saying at the club, you guys had enough money to invest?
There's eras, right? Where you go through periodic changes. In the late 90s, the internet bubble came along and all this stuff started moving online.
Okay.
So Venture Club had to kind of repurpose in the early 2000s into a what's the purpose and function of the club?
Right.
And it's still throughout the the years, it's kind of been the spot where you go for local deal syndication and what's going on, get a little bit of sense of what the investor is looking for from a deal, not just a deal flow, but what's the state of the economy locally doing, and what are the local deals? Who are the local investors? It's very investor focused right now, and it's kind of turned into something that's a lot stronger than it was historically.
So for the venture club, it sounds like something where the investors want to be part of the venture club.
Yeah.
Right? They're ready to write a check. Then you have people maybe a little bit more like you, which you're kind of getting out of your MBA. You're trying to learn stuff, right?
Yep. Maybe
you don't have the ability to write big checks to get invested in some of these companies.
Yep.
But you're hearing about it and now you're learning about it. And Tony, how'd you get excited about venture capital and angel? What happened to you? Because he sounds like he was interested in it. He just got his MBA, and now he's hearing about it, getting in the network. What happened?
Yeah, because I just had my business going for so long, and then eventually sold most of it, and I was like, man, this was really cool. A cool journey. How can I help other people do that? And I think I said it last time. I was like, when I started my company, I didn't have any qualms about working 80 or 100 hours a week. I was a computer nerd. You can code all night long. But now it's after I got through my business, I'm like, I want to back people like that have that kind of drive and that urge. How do you find people who are starting up that want to work their butts off and really go for it?
And so you had the cash, so you were looking at a place to put it, but you also had this thing where you thought you could give some value as well.
Yeah, coaching, mentoring, advising. There were several times big companies tried to take advantage of us even during the deal, and to know what to watch out for. Hey guys.
Could be very helpful.
I'd love to invest with you. I'd love to mentor you a little bit, and I'd like to help you when they come and try to do those little death by 1,000 cuts things they do during a deal.
Right.
Yeah.
So now you're getting interested in it. It sounds like you're pretty excited about it. You're hearing all these new pitches, which for anybody out there who's ever been to a pitch night, it's crazy and it's cool, right? It's not like crazy stuff's going on, but if you're interested in new ways of doing things and new ways of solving actual issues where you could make money, the pitches are really cool. Right?
I have a story that I'll share a little bit later about the I would call it a gold to lead moment.
Wait, that's backwards.
Yeah, it goes the other way. So it's just a little bit of foreshadowing. It didn't turn out the way.
We've never had foreshadowing.
Oh,
no. See, that's the Purdue and IU thing that's going on.
Wow, the combination. You can't really say that about Ball State.
Foreshadowing is usually going forward. Purdue to IU is
going backwards. I hear where you go with that. Always a jab in there.
Hey, no, but the interesting piece is Ben was president of Venture Club.
Yeah.
And so you got to get up in front of the people and talk and run the show. And there's a bit of performing going on there, right? You got to be in front of people, and you got a background in performing, don't you?
I do.
Okay, we're here. We even hit it full throttle. So you liked girls when you were going to college, right? Yeah. And then you decided to do what? Now we're completely off investing. Just want to let everybody know out there, if you're ready.
This is part. That was foreshadowing, Ben.
Oh, that was foreshadowing.
Yeah.
Yes, we're coming back to the performance, the pitch.
The pitch. Okay.
The pitch.
Give it to us, Ben Pidgeon.
What are we talking about? Ballroom dancing by chance?
Whoa!
Yes.
How did you? Yeah.
I think so.
My gosh!
How did you know what I was thinking?
So we have to cut and edit a picture in here.
Yeah,
we're a piece of the video. We got a little video.
You should. Well, so pull in something from True Lies with Arnold Schwarzenegger.
Tango. I just watched that yesterday.
Or Al Pacino in Scent of a Woman.
I'll be back.
I'll be back and do the tango.
Right. So I was thinking, hey, if these big macho guys can do it, surely I can.
And don't call me Shirley.
Yeah, that's right.
Oh, great movie.
So you decided to do some ballroom dancing?
Yeah.
Were you any good?
Yeah, we had some fun. I started doing it. I tried out for the team, and
there's a team.
There's a team at Purdue called the Purdue Ballroom Dancing Team, and I joined it.
And you used to be a wrestler. Like, you used to like grab guys for some fun, and now you're like you're thinking maybe I could dance with some women. This one might be a lot more fun, less sweaty, smells better. And what happened?
Just a little bit. So I ended up winning
smells better.
Trust me, I was a wrestler.
Collegiate National Championship in 1999.
Woohoo!
5-dance event.
Wow! And what were your 5 dance events?
Cha-cha, rumba, swing, mambo, and bolero.
Rumba, cha-cha, I'm saying rumbero,
Rumba.
but
Rumba?
Cha-cha,
Rumba.
rumba,
Not the
swing,
Roomba.
swing.
Roomba cleans your floor.
That's right.
Mambo.
Rumba messes up
Mambo.
Yep, bolero.
And bolero.
Yeah.
Man, that is something totally out from left field. Tony, go.
Beetlejuice.
Beetlejuice?
Beetlejuice?
Did he do that?
Where's he at?
Did they do the Mamba there in the air?
I don't know. I never saw that.
They did, yeah. Yeah, that's
so you were
Michael Keaton, right?
Yes, it is.
Yeah.
Don't say it 3 times.
That's right. I won't.
Bad luck.
National Collegiate Ballroom Dancing.
That's pretty
5
bad.
dances.
Yeah.
That's pretty crazy. I would have never figured you for that.
A lot of practice, a lot of work. You know, 3 hours. And,
Tell us about your hair.
Yeah, and I had blonde tipped hair, of course, right?
I know you mentioned that a couple times. You must have really
he
had
sent a picture from 20 years ago or something?
It was 20 years
He
ago.
sent me a picture. He's like, look,
Like, I can't
dude. He's
believe
like,
what I
hey,
found.
guys, to be an Oscar. Hey, guys, 20 years ago. And I'm like, who is that dude? He's like, I'm like, the blonde hair. Oh, my God, that's you, Ben.
Oh, my gosh. Without a beard, blonde hair, and really tight pants. Is that what you wear when you
No,
do
I think I had a vest down to here. You could see no chest hair, but it was there.
No chest. No chest hair. There was one of them. So.
Right. There's one.
Well, this guy grows a beard in like 3 days, so I'm assuming,
does he?
I'm assuming he looks like a grizzly bear when you take his shirt off. That's inappropriate right there.
So you went ahead and won in 1999, but you go to IU, get your MBA, and now you're at the Venture Club, and you're the president. So you're getting up there, you're talking about this stuff. You're probably doing a great job, right? Because you're a well-spoken guy, intelligent, and so...
It was a blast. So we were planning for the Innovation Showcase that year, and Governor Mike Pence was going to be there.
So what's an Innovation Showcase? What's that mean?
Innovation Showcase is kind of like a showcase of all the local talent all on one stage, where we would bring in 20 companies to pitch for, I think at that time we were doing 1-minute pitches.
Gotcha. So then Mike Pence, who was the previous, what do you call
Governor
it? Governor. Who was the vice president, right?
Not at that point.
Not at that time.
So this was all in the works. This was in like June, where we're planning out the event and the venue, and Pence's security detail is dominating the time of the people that we need to meet with.
Gotcha.
So I was talking to Oscar, and
who's the guy you met who later becomes part of VentureTech. Go ahead.
Yeah. So Oscar founded VisionTech in 2009, and so I knew that Oscar had sold his company 6 months prior. It was all over the news. Sold for $130 million to Brooks Automation, and I didn't know anybody that had sold their company for that much.
That's a big number.
That's a big number. So I said, Oscar, how's life? What's it look like?
I was really stressed for a while.
I paid I paid more in taxes last year than you're going to make in your entire life. Hey, I fall under that too. I mean, $30 million is he must have easily paid in tax.
Yeah, right? Yeah. So then he said, "Oh, it's great. I got a Tesla. We put everything on it."
Oh, he did.
He does have and that thing has got ludicrous mode on it.
Yeah.
Oh yeah.
It'll go.
Side story. He's like, I met him for coffee. My wife and I were out for dinner or whatever, and she's getting a little Starbucks. Hey, meet me. My car's over there. I'll take you for a ride in my car. So she's in the back seat. I'm in the passenger seat. And he's like, now, hang on. I'm going to show you this ludicrous mode thing, right? And so my wife's in the back seat with a fresh Starbucks coffee.
Oh, not a good idea.
He launches this thing. Bloop.
Oh.
All down her shirt, huh?
Oh, no.
I was impressed, though, because that thing's fast.
Oh, it is. Your head goes back. It pulls over a G. You know that?
I did not know that.
Pulls over a G.
It costs over 100 G.
Yeah, and it costs over 100 Gs.
Does that hurt the battery life on the Tesla?
When you hit it? No.
No?
Not that I know of. No way.
And the remaining life of it?
No.
Oh, all right.
All it does is it transfers the electricity to the motors, and it just goes fast.
I think it transfers a little bit more electricity.
Maybe you're right. So
the charge for the day, you just go back and plug it in, and boom, there you go.
Sure. So Oscar said,
Wow, but we digress.
That's right. So let's get back to the story because I think it's fun.
Enough about Tesla. Let's talk about Ben.
Yes, go, Mr. Pigeon. Back to you.
So, and then he said, I'm planning this trip to Southeast Asia. And I've been looking forward to this since I sold my company because one of my investors said that if I return his money, he'll take me on a 6-week vacation to Southeast Asia. So I returned his money and we're planning this trip and I'm looking forward to it. So when's the trip? That's awesome. It's September.
Okay.
And we're in June, July. So I'm listening to these stories of travel and kind of what's going on. And I say, Oscar, who's watching after VisionTech? And he said, well, it's funny that you say that. We're hiring our first executive director. You should meet Tony Petrucciani. And that's how I met Tony.
Wow, I'm so sorry.
Because he said, who's running VisionTech? Oscar's like, not Tony.
Yeah, exactly. So they're looking for somebody who has some background, maybe understands finances would be a huge plus, if not absolutely required.
Yeah. So Oscar's selling it to me. It's probably, it's kind of similar to being a banker, probably a little bit. You got to do these due diligence reports and talk to investors. And would you have any interest? I said, well, yeah, sure. Let's talk a little bit more. And what are the roles and responsibilities, expectations, and I got to meet Tony, and we went back and forth a little bit, and I decided to join on. We had our third child that August.
Not me and Ben.
Yeah.
No,
him and his wife.
My wife, and of course not.
And VisionTech, you didn't really explain what VisionTech was all about, and we know what that is. But VisionTech is really what angel investing.
Yeah.
And so it's maybe you can just explain it better than I can.
So angel investing is the process of making an investment into an early stage company that's trying to commercialize an idea. So they've got a service or a product or maybe
early on, hasn't been overwhelmingly successful, but has a good idea, is making some traction, and you guys go ahead and help invest, but also help guide them too, right?
Yes, absolutely. So once you write a check, you've got to make sure that you know which way the company's going, what decisions are being made, and try to guide them in a way that's productive and creates value. So
some of them want guidance and help.
Some of them want guidance.
Some of them, I don't want to feel cheap here, but some of them just want the money.
Right. But you can see
kind of like
that.
dating.
Yeah. Some of them want one thing out of it. I think
when you're dating, sometimes they just want the money.
No, they just want like certain things, but they don't want everything.
Hey, let's keep it above the table.
I thought I was trying to keep it really high. But Tony, you got involved with it with Oscar, but you're also involved in 50 companies?
Ish. Yeah.
We talked about it last time.
Maybe a little more now.
So you really like to help because you and I have had many conversations. But did that draw you to VisionTech? Like, it's not just the money; it's really the helping and the money and trying to help these companies succeed.
Yeah, absolutely. I mean, I'll tell you what really attracted me was this idea of talking to founders, brilliant people every day, learning about new markets and how they're approaching it and what their critical thought is of breaking down a certain problem and how they've quantified a problem. That kind of pulls you in. I mean, it's very much like Shark Tank.
If you like hearing visionaries, that's what I got out of it. If you like hearing these guys that sit there, or ladies, or whatever, sit there and talk to you about, this is how I'm going to revolutionize the world. And once you hear some of those pitches, it's pretty amazing stuff.
A lot of passion.
But looking at a problem so differently. Yeah. I remember, Listeria, and trying to solve the problem with disease in vegetables. Yeah. And how they were going to do that. Or the guy that, like, if you're at a NBA game, he can feed you data to either your smartphone or your iPad if you're sitting out in the crowd, and all kinds of commercials and stuff. Yeah. But it's just like this very different way of looking at the world. And I find it fascinating. I feel like I'm just a little closer to greatness when I hear that. I know that's kind of crazy. Not next to you guys, but the guys.
No, you're right, though. But you can be involved with a company that does something incredible, and you're like, I knew them when, or I was an early investor, or I was an early advisor, or I like Ben does this a lot. He works with these teams come in and they pitch, and he's like, you need to do this, you need to consider this, what's your answer for that? And then they go back and iterate, and then by the time they pitch, they actually get money where they wouldn't have if they wouldn't have listened to his advice early.
Because they're giving better data, right? They're doing a presentation that resonates with the investors because they want to know how they're going to get their money back, right?
Yeah.
And so when you help them, that is significant, because if a company doesn't have enough money to actually grow and to keep going, then they're dead in the water, right?
Yep. Got to live to fight another day.
You have to live to fight another day. That's true. Now, Tony, you told me one time that one of the reasons you wanted to do it, and I don't have these statistics right, is that in the Midwest, they create, and I'm just making this up, 30% of the ideas, but only about 15% of the capital comes from the Midwest to support those ideas.
And Ben
and I can't remember. I'm throwing them out, but the whole idea is that there was this disconnect between the ideas that are generated and the amount of capital in the Midwest that supported it. So what are you going to say?
I don't have those numbers on the top of my head, but generally a lot of the capital flows to the coasts, right? You think of
East and West, right?
East and West. New York and California are really the main hubs of where the majority of capital is invested.
Right.
There's a trend, though, that the Midwest and other regions are starting to see a little bit more traction. But, as just a pure dollars going into Midwest deals and other areas, we're
there's a misalignment.
Oh, absolutely.
More ideas come out than they're funded. Go ahead.
And I would argue that the Midwest is a great spot to put capital because we could be more capital efficient. I mean, just look at the cost of office space in any one of those locations on the coast, New York or San Francisco, versus what you could operate here. A $1 million round out there might last you 6 months. $1 million round in Indianapolis could last you 24 months, I would argue.
And we talked about, when we talked to Kobe, he made the discussion that if he stayed on the West Coast, he would burn through. It's like there was some crazy statistic that he had. It's like the square footage out in San Francisco, I'm making this up, was $200 a square foot, but in Indianapolis it was like $12 or something. Yeah. And he could make it last so much longer. And people who were in the Midwest, you would be paying, what do you think, $200 for a good programmer on the West Coast, but you could get somebody great here for 80 or 90, whatever it was.
Yeah, there's this just difference.
Complete difference.
I mean, we used to compete a lot in the Midwest against Chicago. We lost a developer from Indianapolis. He moved to Chicago because he wanted to get, he was getting a 15 or 20% pay raise.
But
I was trying to tell him, hey, the cost of living is going to eat that all up. Because but I just want to be in Chicago.
Well, for some people that's true.
So that works. But you look at what San Francisco is, for living costs, the living expenses is crazy. And so I think you're seeing several companies that are opening hubs here because we've got great schools like IU and Purdue and Ball State, and Rose-Hulman. I mean, you got a lot of places where we can get technical developers that'll come in, and it's cheaper to live here. They're going to be educated as well at school. I know there's this. This is a better school or whatever. But
right.
You're getting these people that want to be. They're from the Midwest. They got good, solid values, and they don't want to pay $4,000 a month to live in an apartment.
Right.
And so then you don't have to pay them as much. Not that they're not worth as much, but it's there's just a difference in the cost of living.
You're
saving the difference.
COLA. And so you get involved with VisionTech. You meet Oscar. You and Oscar started VisionTech, or did you come on later?
I came on just as Oscar actually started it under the name of Stepstone.
Stepstone, okay.
And then he had some partners in that, and they were kind of reaching the end of their program, and they wanted to go a different direction. And so he took all of the stuff he was doing. He said, "I need a couple new investors. I'm gonna rebrand as VisionTech," and that was 2014. And just so happened I had a connection with a couple of people that brought me in to meet Oscar. I ended up meeting Oscar, and that was the time when I was trying to figure out what I want to do when I grow up, which I haven't started that yet. But so 2014 I got involved. That was 6 years ago, December, I think, is when I joined.
So you guys started to do lots of pitches, and you started to look, and deal flow is the number of companies that want to talk to you, right?
Yep.
And how much money did you guys raise in 2014? Or Were you guys 10, 20? I can't remember.
No. It was there was a smaller group of members. They did invest really big in one company. Orthopediatrics was kind of their big thing. There was a heavy flavor from Warsaw, Indiana, which is the orthopedic capital of the world.
That's right.
And so they were investing in some more med device type stuff.
MDD.
And then they went into when I got involved, it was kind of like, hey, we got cloud software is getting really big, SaaS model stuff, and so we still do 40% life science, but 60% is more other business, mostly technology, and so it's a little bit different game. So we've gotten to the point where I think last year we invested a little over $3 million,
$3.1 million into 15 companies.
See,
so there's an era right before Tony joined. There were 10 companies that received about $2.5 million.
Okay,
and one company had one investor.
That's from 2009 to 2014-ish.
Yeah,
early $2.5 million.
Yeah. $2.5 million.
So not huge numbers, right? Especially not for an angel fund or a fund. But go ahead.
No, and I think the philosophy back then was, 10 companies should get you enough diversification.
Now, and I want to get back to that, but can you tell me, when you invest in companies, you're investing in a pool, right? And you're thinking about that pool. If it's 10, one of them or two of them are going to go to Zippo, right? Mm-hmm. Like what is kind of the mindset?
I wish it was
that would be good.
Actually, you know what? That's where we're at, though.
Yeah.
Our numbers are right there. We're
So tell us, can you tell
us? But that's not
a bit of the numbers?
That's not average.
Like the ACA and Kauffman Foundation, some of the groups have studied like big, like thousands of investments over
15
or 20 years.
Yeah.
They're showing that like 50% or more go to zero.
So hold on. Let's just backtrack, and I'm going to get right back to you. So for the people that are listening, they're sitting there going, now you actually invest in it, meaning like you can throw money into the fund, which has a number of people who throw money in, and then you decide which ones are good ones to invest in. Then you could say, hey, you're listening to all these pitches. Are there any of them that you would like to invest in directly? And then you can write like a $2,000 check or $5 or $50 or whatever. But in the fund, you take a very methodical approach to it, and you say, hey, go ahead.
Well, so let's reframe a little bit on how VisionTech works.
Please.
So VisionTech is a group of about 120 accredited investors.
And an accredited investor means they make enough money that if they lose 20 grand, they're not going to go absolutely poor and live in the poorhouse, right?
Yep.
So accredited investor is a very specific term.
And more importantly, they're not going to sue anybody.
Right. Okay. They're not going to sue anybody. Right. Like, I believe that.
Okay.
Back to you, Ben Pidgeon.
Yeah.
So you got these accredited investors.
So we've got 120 accredited investors. We have a process that we go through, and I will affectionately refer to my investors as volunteer check writers.
Okay.
So they have to follow a deal through the process, indicate a level of interest, indicate some sort of line of questioning around what they'd like to see answered in a due diligence process, all the way to publishing it and consuming, reading a due diligence report, and then deciding to write a check.
So you've got all these people. You got somebody that says, I got this great new idea. They give you lots of information. These people will read that information, will ask questions because they may be pessimistic, or they may just have questions like, I'm not really sure how you can raise 500 cattle every week or whatever. It's some crazy question. Then you want to go ahead and investigate that. You do due diligence where you look at the information, ask questions. And then when you get to the end of it, you kind of make a decision, right? Mm-hmm. Hey, this sounds like a good idea. And at that point, people will or will not write checks. Correct?
They have a choice. Yeah, absolutely. So it's it's not a traditional fund. There's a lot of funds out there where you have an investment committee that gets together, here's a pitch, does due diligence, and then votes. And then
you write a check.
And then you write a check for $100,000 or $500,000 or some dollar amount, or that fund might even set the terms of the investment.
Right. Negotiate.
We're typically not the group that will set the terms, but we'll be the one that tops off the round typically.
Gotcha.
But the concept of a fund is you're committing so much money ahead of time. You're like, hey, I'm going to put $100,000 in this fund, $50,000, whatever.
And that's a lot of money for people
over
that we're
4 years.
Talking to. But
maybe it's over 3 or 4 years, and I don't get a say in anything where you invest. I'm just going to trust you guys. Mm-hmm. And then the Shark Tank side, which is what really we do, is you go look at them and you go, I want in or I want out. And instead of just picking based off of watching a show for 15 minutes,
right?
Ben runs a tough due diligence process. A lot of times it's 40 hours or more of investigation from sales and product, technology, legal, the whole deal, publishes that report, and then people say, I'm in. And it could be as small as a $2,500 check. We've got some people that write a $100,000 check. It's not the typical thing where you think people are just writing $1 million or $2 million checks at our level. And then we put those all together. But you make your own decision on every deal, and you might do one a year. And
you lock up the money, meaning when you write a check, this is a new company, and it doesn't turn over in 6 months or a year. Mm-mm. So what I mean by locking up the money is you write a check and you put it out there, and it's for 5, 6, 7, 8 years.
Yeah. Average hold period's around 4.5 years. I've talked to other angel investors that have had returns in 9 months. I've also talked to investors that have had 10 years to wait. So you don't have a liquidity event. A liquidity event is something that generates cash that returns back to the investor. And those liquidity events are either an IPO or maybe somebody
public offering on a New York Stock Exchange, right, or another exchange. Go ahead.
Or another company acquiring them for cash, or maybe you get stock in that next company that makes the acquisition.
Man, you guys look so good. I want to acquire you because you're going to be a bolt-on to what I'm doing that's really going to make my company explode. So I'm going to give you X amount of dollars, mm-hmm, or stock or whatever other item. Now, the angel investing, the thing that makes it great, different than venture capital, is that the angel is like an angel that helps you and guides you and provides advice in order that you can get to an exit, meaning somebody acquires you or you go for an IPO. And so angel investing is very different. And I like it because you get to watch it grow, and that's pretty cool, give advice. And then at the end of the day, you get to participate in like that growth, and that's pretty cool.
Yeah.
So now you've got this company, you got VisionTech, you're a part of $2.5 million. You raised additional monies. Can I ask how big the fund is nowadays?
Well, we don't have a fund. We've been talking about launching a fund. Maybe we should talk about that.
Well, the total money. So when
total money that
the
you
total
guys,
money
so when
invested.
VisionTech came in, we had invested a little over $2.5 million.
$2.5 million.
Mm-hmm. Yeah, we're at over $21 million now.
Right.
Yeah.
So in the last 6 years, it's
more and more
grown
people
substantially. Yeah, each of the last couple of years, we've invested more than $2.5 million in just a year.
Right.
And it's interesting how you start getting some success and it snowballs, and now people we're getting better companies, deal flow they call it, but we're getting better opportunities
and better companies
and Ben kind of made reference to it here a second ago, but sometimes we get to lead the negotiations because we're going to write such a big check that we get to actually negotiate on the terms.
Exactly.
Like a lot of times they'll go like, you've seen it on there. I'm going to sell 10% of my company for $1 million. And they're like, that means your company's worth $10 million?
Yeah, exactly.
Okay, so how much were your sales last year? $6,000.
Yeah,
they're like, no. But so what happens is you have to actually guide them and advise them, and you got to get to a point where it's a good number because they're probably going to raise multiple rounds. So the next round, every round needs to go up and to the right, So if we raised a round,
and what do you mean by up and to the right?
Like on a chart, if you're looking at a chart, right? So we say up and to the right, which is probably this way for the camera.
Right.
So if I sold some percentage of my company and my company is worth $3 million today, then when I sell it next year and we raise more money, it needs to be worth more than $3 million.
Right.
Maybe $5 million. Then the next time is like $10 or $15 million. And it keeps going up. The dreaded what they call down round is horrible because now you're selling a bigger chunk of your company at a lower price, and all the earlier investors are getting hammered. Like hammered meaning they're worth so much less, they're losing money, and they can't get out because these are highly illiquid. Liquidity is I can't go on the stock market and sell the shares.
Yeah, so when they're illiquid, like I always explain it that liquid, like water, it flows easily. So when you're talking about something that's liquid, especially from a financial perspective, the money flows easily. If you want to sell it, it's easy to sell it. But if it's illiquid, it does not flow easily.
It's like a chunk of rock.
Right.
And you're trying to sell it, and you got to sit there and wait and wait and wait and wait.
How many buyers are out there? How many sellers are out there? And the quantity of buyers and sellers determines how liquid something is.
Yes. And, when we start talking about angel investing or venture, you lock up your money for a while. And if you're even interested in such a thing, you're looking for a fund or a group that offers the ability to write smaller checks, because we all know they're willing to take bigger checks. But if you're trying to get in and you like this and you like hearing about new companies, which I loved. I mean, did you like it, right? Don't you, Ben?
I do, actually. And the line of thought that we're going down, I want to make just a really good point here. And that is...
We only like good points.
I don't know how much time we have here, but...
Keep going.
You could do this alone. You could absolutely, if you're an angel investor and accredited, you could do it alone. You could write a check for $25,000. That's probably the smallest check that you could write if you did it alone.
Right.
Part of the issue with that is that you usually aren't going to, that's not a size of a check that you get to negotiate terms. It's also probably not a size of a check that will allow you to get something called major investor definition, which would qualify you for information rights.
So you want to know what's going on in the company.
Information rights give you a right to get into the company financials, find out what's going on a periodic basis. And a $25,000 check probably isn't enough to get you there. Usually we see that around $100,000, maybe $50,000, depending on the size of the company and where they're at in commercialization. We've seen them as high as $500,000. But
yeah, $250 to $500. Like if you're putting that much in a early stage company, you get a lot of rights and you can tweak the terms. But if you're writing a check, I know it sounds like a lot, $25,000 as an individual, but to a company that's raising $1 million, they're like, it's 2.5%.
It's a lot more work.
I don't want to spend all my time talking to these investors that invested 2 or 3% of my company. I need to take care of the big guys who are writing a check for 25%.
Right.
And those are the ones that are going to help me more, right? It's going to be more meaningful. Like this, if I wrote a check for $10,000, which is a lot of money, but out of a $2 million raise or $1 million raise,
not so much.
It's not so much. And then if I'm squawking at them all the time, like, hey, I want to know what's going on. How much, what was your expense on your rent last month? I want to know. Like, that will distract the founders so much from hitting their goal, achieving their goals. So we try to protect them. So like with VisionTech, we end up taking the manager role. And so whether there's a board seat or a board observer seat or just information rights, we get that, and then we send it to our investors, which we might have 40 people invest in a company. And then we insulate that founder. So
the founder only talks to one person, and instead of 10,000, 10,000, 12,000, whatever, you have 200, 300, $500,000, whatever it is.
And then Ben knows how to talk to these guys. He's talking to all the
you speak
the
the
guys
same
and
language.
gals, and he speaks their language, and he says, look, you're going to raise another round, and we need to get this information from you so I can present it to our investors so that they'll invest in the next round, and we're going to hopefully make this easier.
Smooth,
so
right.
He knows how to smooth it, whereas somebody who's like really worried about their $10,000 and they're calling all the time and pestering this person really, and then all of a sudden maybe they get them mad, they don't want to talk. It's like, you don't need that.
No, and the other thing that happens too is if you do it alone, the kind of the flip side of that is do it alone, and a year goes by, and you have no idea where the company's at. You haven't received any updates.
They're not really protected. You're out there on their own.
Right. Maybe the company's used that investment of $25,000 of precious money. I mean, that's a lot of money for some people.
Yes, absolutely.
Right.
And we're really trying to open people's minds here to like the different types of investment stuff that's going on. And angel investing is very cool. So
and so 11 months go by and the founder comes back and says, oh, it was great. This is all the stuff that we learned. And our original hypothesis was completely wrong.
Yeah, I know that.
And if you don't write a $50,000 check, we're going to shut down the company in the next 2 weeks.
And that's why, especially when we're talking about investing, this is a very risky proposition. If you don't have help, and if you don't know what the heck you're doing, and you don't have deeper pockets, it could get really dicey. So we're not saying, hey, invest in angel funding or venture capital. We're just saying there are different ways to invest, but they have different risks associated with it.
Yep.
So Ben has to not only kind of manage all of our investors, and we've had nearly 200 people write checks over the years. So he's got 200 people asking him questions.
So when you have a K1 of 900, that makes sense.
Yeah, and then he's got to go wrangle all the founders, some of which want to talk to us. Some of them are like killing it, and they just love telling us stuff, and some of them miss stuff, and they don't want to talk to us. So he's got a lot of different conversations to have.
Yep.
It's it's not fun to have difficult conversations, right? But they got to happen.
Yeah, you definitely have to have those. I mean, every company out there isn't just crushing it all the time. You know, they're having stumbles. And Tony, we talked about you having your stumble. I've had stumbles along the way. And if it was always up, then this wouldn't be risky whatsoever.
Yeah.
So if you had 10 companies, you were talking about the fact that a couple of them may go to zero,